Well, good morning, everyone. Thomas Montgomery. It's great to be with you this Thursday morning. Today is August 21st, 2025. We get together most weekday mornings, talk about strategies, tips, share success stories, and support each of you. Today's a really exciting topic. We have been talking over the past couple of weeks about ABL, asset-based lending, and how it is an innovative and usually a preferable approach in helping small business owners access capital. If you've missed those prior trainings, you can go to our YouTube channel and get caught up. Today, we're going to use ABL in a specifically different way in terms of using it to buy real estate. So, screen should be shared with you. And the subject is real estate financing with 1% down using ABL. You've got our website and our support text. All right, so with that introduction, rather than using traditional real estate financing, individuals and entrepreneurs now have a new financing option called asset-based lending. Now, the truth is, if you think about it, normal real estate financing is asset-based, right? So if you and I go buy a home for our family, in a traditional sense, that home is going to be pledged as collateral for the loan. And if we don't pay the loan back, we don't pay the mortgage back, they'll foreclose on the property. Similar if we're buying commercial property. So the truth is, normal real estate financing is asset-based. But what we're going to talk about today is using different assets as collateral that results in the client owning the real estate free and clear. So hopefully that makes sense, and we'll go into more details as we go along. 509 Pacific is a 501c3 nonprofit, and we've been building a strategic alliance whereby we can provide both the assets for the ABL. So again, we're going to use different assets for the real estate financing, not the real estate itself, which I'll talk more about, and then as well as access to the ABL lenders. The end result is that we can get real estate, any type of real estate, for just 1% down. And think about that. And I know some of you are veterans, and thank you for your service. But unless you qualify for some sort of unique home mortgage, the down payment might be 3% or even more. People that have challenged credit might not be able to get approved at all, or might have much higher percentages. If you get into commercial real estate, the down payments are often 10% or more. If you get into those dreaded hard money loans, it can be a lot more than 10%, can be closer to 20 or 30. So when we talk about just 1% down to get real estate, that's extraordinary. Now, of course, there'll always be a pessimist in the room saying, well, why is it got to be 1%? Why can't it be 0% down? Well, theoretically, we can finance the 1%, so that would make it 0%, I guess. All right, so let's talk about the benefits of asset-based lending in this spectrum, in this application, where we're using it not to get working capital for a business, not using it to go acquire an existing business. We're using it specifically for real estate. Could be residential or commercial, could be a place for us to live or investment property. Don't worry about the type of real estate. This works for any type. All right, so let me go ahead and scroll up, and we're going to go through the benefits of asset-based lending in regards to real estate finance. Well, the first of all, the first bullet is exactly as we stated, only 1% down. And as I mentioned, if we need to, we can finance that 1%. So that does significantly reduce the out-of-pocket cost. Now, if you think about buying real estate, there's usually more to it than just the down payment in a traditional transaction. In many cases, you'll need to have an appraisal. You'll probably want to have an inspection. You're going to need, typically, once you purchase it, insurance. There might be rehab involved. Might be furniture. We're working with one client. He's going out and buying real estate, residential real estate, and then he's leasing it out through the different Airbnbs and such. So he's doing short-term rentals. So when we're helping him get real estate, he doesn't need just the real estate. He also needs the rehab and the furniture. So we can do all of that for just 1% down. We can finance all of that. We can finance a lawnmower with it. We can finance a car if they want a new car with their real estate. So it's unrestricted funds, which we'll talk more about in a moment. 1% down. The second very important benefit is that our model is one whereby we're providing the assets. So again, we're not going to use the real estate as the collateral. We want the client to own the real estate free and clear, no lien, no encumbrance against the real estate. So if that's the case, then there has to be some other asset that's being pledged. That's exactly right. And that's where we use ABL. So we're going to set up a business. So the transactions will be through the client's business, through a shelf corp we provide. And then we're going to use business financing to take care of the real estate transaction. When we say that we'll provide the assets, we're going to provide in $1 million increments accounts receivables, which we've talked about before, and that's going to serve as the assets. So hopefully that makes sense. If not, feel free to type in any questions, comments, concerns in the Q&A. This is going to increase accessibility. There's a lot of people that rent right now. Let's look at just the residential section. If you were to go survey most people that are renting an apartment, renting a home, renting a trailer house, most renters, not all, but most renters would rather own than rent. Well, what's the problem? Usually they can't get approved or they don't have the down payment. So when you start thinking about how large that market is, how many renters are out there that you and I could help be able to get their own home, because of the greater accessibility, it's an incredible opportunity. And this isn't about competing with realtors. If you're one of our distribution partners, you should, in my opinion, really be out there educating local realtors how you can facilitate the financing. You're providing them a new alternative to traditional financing. At the residential level, usually a consumer would have a real estate agent and then a mortgage loan officer, maybe affiliated with a bank, maybe not. Those are the two professionals normally that are involved, in addition to the title company, of course. Here, you're not competing with the banks, but you're offering the realtors an alternative, because not everyone can qualify for a mortgage through traditional means, but anyone can qualify through what you and I are discussing today. So the bottom line is increased accessibility. Another big benefit is that there are no minimum credit requirements. As we were talking about, why do a lot of people rent on the residential side? It's because their credit's not good enough, or again, they don't have the down payment. And then you have the other side of businesses, commercial real estate. And so if you're a business owner, you need a business address. You probably need a business to operate out of. And so instead of paying someone else's mortgage rather than leasing office space, a lot of these entrepreneurs could instead work with you, use an asset-based loan for the real estate, and then they could own the real estate. And that's obviously a better option for most. So there are no minimum credit requirements for the real estate ABL. Why? Because it's based off the value of the assets versus the credibility of the borrower. Again, if you have any questions, comments, concerns, feel free to type it into the Q&A. Faster approval and funding. And so if you think about the normal time frame, whether it be a residential purchase of real estate or commercial, it can often take 30 days or more. We're looking typically at 7 to 10 day turnaround, so much quicker. Next bullet is flexibility in funds. And I alluded to this earlier, and this is a really big deal. When we get an ABL, it is unrestricted. So we don't even have to tell the lender what we're going to use it for. We're not restricted. So we could use it to go acquire a property. In other words, buy a property. We could construct a property. We could rehab a property. It could be residential or commercial or multifamily, a hotel, apartment complex, and so forth. Next are higher borrowing units. So typically, people will be limited, especially on the residential side, people will typically be limited in how much of a home they can finance based upon their debt to income ratio, DTI. And so that's not so easy to fix. I mean, you can help people maybe budget and reduce their expenses. You can give them some career training of how to get a better paying job, but those aren't easy fixes. Here, the ABL is only capped by the amount of assets that we're going to provide. So we provide them in $1 million increments, but we could certainly go to 2 million or 3 million or what have you. We're not going to run into the traditional barriers of DTI limits or credit restraints, which we've talked about before. This may be one of the biggest benefits, and maybe it should have been at the top, but I was talking to several of you yesterday about this, and I think it was Corinthian, but I forget who told me. She said, this is the biggest deal of them all, because when we help a client get ABL, they have the cash in hand. We don't have to have already identified the real estate that's going to be purchased, because that takes time. It's through a traditional process. You have to figure out what real estate you want to purchase. You have to have it appraised and inspected, make the offer and go through the whole process. Well, there's a lot of people out there that are cash buyers, and they'll zap up the real estate before you can navigate through the process of a normal real estate financing transaction. Here with the ABL, the client already has the money in hand, so they're literally a cash buyer when it comes to purchasing properties. I mentioned this before, and I'll describe how this works so it doesn't seem too good to be true. Our approach is we want clients to own the real estate without a lien. Now, how does that work? Well, let's talk about that. So we're going to provide them a free shelf corp, and I've got some steps down here we're going to go through, but before we get to that, how does this happen legally and ethically and really? So we're going to provide them a shelf corp. The shelf corp is going to get the asset-based loan, and then the shelf corp is going to then transfer some or all of those funds either to the individual or to a different business, a second business. Then it's that individual or the second business that is acquiring the real estate. So the shelf corp is taking care of acquiring and paying back the funds, but it's a different entity, a different organization, a different person that actually owns the real estate. So if you're following this, that's a really big deal, because let's take Alfonso, who's on here. So let's say Alfonso wants to go buy a piece of property. So he uses the ABL. Now he owns the property, but the property's owned free and clear, as we're talking about here. Well, why does that benefit Alfonso? Well, if things got tight, he could still borrow against that real estate because it is owned without any encumbrance. It was not pledged as an asset. It was the assets that we provided them that was pledged as an asset. So you're technically doubling the borrowing power of a client. This one's a little bit more advanced, so I'll attempt to describe it in more detail. We'll pay your mortgage. So I want you to think about two buckets of money. The first bucket of money is the money that is borrowed through the ABL. And we normally go in $1 million increments. So the left bucket is the $1 million that we access through the ABL. But in addition to that, we're leveraging the AR that we're providing to qualify for that loan. And then we're licensed, bonded, and insured as a debt collection agency. So then we're going to liquidate that AR, in other words, turn it into cash. And that goes into the second bucket of money. So the way the model is developed is that we anticipate bringing in more income each month through the second bucket, through the liquidation of AR, to be equal or more than the mortgage payment, the ABL payment that's due from the first bucket. Does that make sense? And that's an incredible deal, because obviously, if the client doesn't have to come out of their own pocket to repay the ABL, to repay the loan, guess what? They're going to be able to afford more funding, more real estate. So, any questions, comments, concerns on the benefits as stated? Just go ahead and type it into the Q&A. We'll see what type of responses we get there, and then we'll move into the steps. So, what are the steps? So the steps are pretty consistent with how we operate generally. So we've received a grant. The grant has 3 mandates, if you recall, one of which is to improve financial literacy, the second of which is to give away free shelf corps, which is relevant to this. And then the third mandate is to increase access to capital. In other words, use that education and those shelf corps to get money into people's hands. So we give away shelf corps. The reason that we do that, the reason we applied for the grant to do that, is that you need to have a fundable business foundation to be able to borrow money. A lot of people have businesses, but in many cases, those businesses are not what we call fundable. So instead of fixing what they have, we found that it's easier, faster, quicker, better in most cases, just to give them a clean shelf corp. There is a processing fee to get the shelf corp transferred. How much that is dependent upon our referral partner. So we have about 1,000 referral partners. Obviously, not everyone's on today's training, but the bottom line is each referral partner determines what that processing fee is. So you would have to ask them what that processing fee is. But with that, the Express Shelf Corp is providing kind of that business in a box so we can do these things. The business entities in good standing at the state and federal level. We provide a bona fide, legitimate commercial address, business plan, use of funds, financial projections. So all of this we can get to the client in about 7 days. So that's a quick turnaround. Once we have the shelf corp delivered, now we can start using it for funding purposes, such as getting real estate financing through the ABL, which is our topic today. So if the client, we're going to visit with the client once we have delivered the shelf corp, number one. We'll determine what they're wanting to do. And like Dwayne says, yeah, some people want to buy a business. Some people want to start a business. What we're talking about today is real estate. Now, we can use ABL for any of these purposes because it's unrestricted funds, but our goal today is to talk about how to use it in the real estate space. So then if they're wanting to use the ABL, then we'll transfer legally and ethically. Yes, it's legal. We're going to transfer the assets in the form of accounts receivables over to them. There's a bill of sale. Everything's legit. Everything's written. It's the real deal. We've done this with large law firms. So not to buy real estate, but for other purposes. So yes, it's real. So then number 3, then we can initiate liquidation. And the liquidation is important because if what we're going to do is pursue an asset-based loan, what's the underwriting based upon? It's underwriting. The underwriting is based upon the assets. So we're providing the assets, but the lender is going to, if not expect, in many cases mandate that there's a liquidation going on, because if we're liquidating the AR, then they know that the loan can be repaid. If we're not liquidating the AR, then we're going to have to prove up cash flow otherwise. So then we can apply for the ABL, pretty quick turnaround, 7 to 10 days typically, and I think I mentioned that earlier. And then, of course, then the client receives the funds. When they receive the funds, as I've mentioned, it is unrestricted. unrestricted. It doesn't have a specific use. So that's a big difference here, is they don't have to necessarily know what they're going to do with it at this point. Maybe they're not sure of what real estate they're going to buy, or maybe they're like Dwayne. Dwayne's looking to buy an existing business. The funds come unrestricted, so it doesn't even have to be used for real estate. But within the scope of today's discussion, they don't have to have already identified what real estate they want to purchase. Lastly, and then we'll get to the rest of the Q&A, we have a great referral program. And again, we're not competing with realtors. I think you becoming a referral partner and educating realtors about this alternative financing is going to solve a lot of their problems, and it's going to make you a lot of money. You have some realtors that focus on first-time home buyers. Well, those folks often have trouble getting approved because of credit, DTI, or down payment. We eliminate all of that. Others work in commercial space, some work in residential, some do both. But if you simply can find realtors online or in your community, you're going to be able to generate a massive number of referrals, not competing against what they currently do, but essentially serving as an alternative source of financing, especially for those that can't get approved traditionally. And there's a lot of people out there. When I worked at the SBA and we first started building this, I was going out to apartment complexes. I'd go to the property manager, I'd get their permission, and then I would work usually with a local realtor, and we'd do a home buying workshop. And you might say, well, why would the apartment complex let you come in to do a home buying workshop? Well, most apartment complexes know that they have a transient resident base. People usually don't move into an apartment to stay forever. So the more value add they offer, the better it is. So with that being said, there's so many ways to get the word out and marketing to real estate professionals, or even marketing with them and doing workshops. But regardless, you're paid 5%, which isn't get rich quick. And I know for a lot of you, that's not a big deal, but you're paid 5% for each deal. And so we're doing them in $1 million increments. And the reason for that is that's just where the lenders are. Some lenders won't go below 5 million, as we've covered on prior trainings, but some will go down to 1 million. So if you're making 5 points off of 1 million, that's 50,000. If you want to split that with a realtor, you can. You don't have to. But if you put that in comparison, are any of you current realtors? If you could respond in the Q&A, I'm just curious if anyone is currently a realtor, a licensed realtor. Could you respond with yes in the Q&A? Because I think if you talk to anyone that's knowledgeable about the real estate space, okay, so Jennifer is, Doug is, so Jennifer and Doug and others, is 5% on a transaction more or less than you normally make? So in our model, you would make 5%. Are you currently making more or less than 5% through your traditional model? So Jennifer and Doug were waiting. Jennifer says less. Doug hasn't responded, and that's my understanding. I think that in general, realtors are probably making 2 to 3 points, because usually that's split between the buyer's agent and the seller's agent. So not only are we able to help realtors solve a problem, how to get their unapproved clients into real estate, we're also in many cases getting them into a bigger deal than they would have qualified for otherwise. And then we have a higher comp plan at 5%. So again, it would be you. Doug says he's making 2.5 points. So you could go into it and market to realtors, home builders. There's manufactured home lots like Clayton Homes and Palm Harbor Homes that have people that are coming in and trying to buy those alternative forms of housing for their family, but not everyone gets approved. Not everyone has the credit worthiness. Not everyone has the down payment. So in this case, we're able to get it with 1% down And if we need to, we can even finance that 1%. So what questions, comments, concerns? I think if you see it the way that we do, this is a really big deal. So ABL is great in general, and we're finding that more of our clients, our traditional business clients, prefer ABL over SBA loans. Let's look at an SBA loan, for example. With an SBA loan, the SBA requires a minimum of 10% owner contribution. So let's say that they're going to buy, just to keep things equal, $1 million piece of real estate. You're going to buy an office building. So if it's $1 million, according to SBA and most traditional business lenders, the borrower would need to bring 100,000 to the table. Well, there's a lot of people that don't have 100,000 to bring to the table. But with the model that you and I can offer, it's 1% down, much more attainable. And if we need to, we can even finance that 1%. So if you're in the real estate space, I think you'll appreciate how big of a deal this is. If you're not, you might want to consider more so how you could be a resource, help these realtors get the approvals that they're not able to get now. Again, they might be happy just because they're going to still be paid their normal way. So maybe you want to share your commission with them, maybe you don't. But developing these types of relationships in your community can be incredibly lucrative. All right, so let's go through. Jennifer asked how to get started. Well, yeah, we covered those. We covered those steps. So these are the steps, Jennifer and anyone else. Question about location. We can do this anywhere in the country or anywhere in the world because it's unrestricted funds. So that's not a problem. And Joseph's asking the fee to get the assets. So yes, they're paying 1% of the assets, which we've covered in other trainings. So they're paying 10,000. But is that an expense or is that a purchase of an asset? It's the purchase of an asset, right? Because what's that $1 million of AR worth? It's worth $1 million. Now, will we collect all million as we liquidate it? Probably not. We'll not be that fortunate. But the bottom line is, if you could go buy a piece of real estate and get it for 1% of the value, would you buy it? Well, of course you would. If you could go find a car that they were selling for 1% of its value, would you buy it? Of course you would. So this is a different type of asset. But the answer is yes, they're going to pay 1%. I think what Joseph might have been getting to is, can he mark it up? Sure. So if you want to mark up the acquisition cost of the AR, you can. And so we got Ben on here. Ben, if I recall, Ben is selling it to his clients for 5%. So Ben and his team are literally making 4 points off of it. So his clients wouldn't pay 10,000, his clients would pay 50,000, and 10,000 comes to us, the 1% which we need to cover our cost, and then 40,000 is going to Ben and his team. So yes, you can get creative if you want to mark that up, because it's certainly worth more than a penny. We're just trying to make it as simple as possible. All right. Okay, and then I see a couple asking about the liquidation. So we're licensed, bonded, and insured to liquidate. So let's go back down to where that is. So the way that the liquidation works, it's number 3 here, is that we're paid out of the liquidation. So sure, we can't afford to do all that work for free, but it doesn't come out of your client's pocket. Instead, the collection costs are coming out of the debtor's pocket. It's, in other words, added to what they owe. So we've had some other trainings about that, but that's the beautiful thing. We're working for free for the client to liquidate it. We're paid as an additional cost to the debtor. And that's often how it works in debt collection. Okay, so let's see what other questions we have here. Some of them were about liquidation. Lainey asked about owner occupied. Yeah, I don't know what else to say other than to continuously reiterate it's unrestricted. There's no restriction in the use of funds. So when I say that, it can be used for anything. It doesn't have to be used for real estate. It could be used for real estate. It could be used for owner occupied. It could not be used for owner occupied. I don't know what else to say to all of you. It's not restricted because it's based on the assets that we're borrowing against, not on the real estate itself. Hopefully that makes sense. I know this is unusual compared to how you normally think about real estate financing, but if you can kind of clear your mind of how it normally works and separately and distinctly understand how this works, there's some significant advantages. Chris asked, what if the client needs 5 million? So that's right. So then we would do 5 portfolios all through one shelf. So we'd only need one shelf corporation. But then if they need more than 1 million, then we just get multiple portfolios. It's not a problem. Still 1%, methodology still the same. Thank you, Chris, for that question. Let's see. Ben's asking, and again, I'm going to draw an analogy and I'm going to regret it, but I'm going to do it. So MCAs, merchant cash advances, not what we do, not what we do. But if you know anything about merchant cash advances, it's what? It's easy underwriting. As long as the business has enough in cash deposits, then they get approved. They can have shitty credit, normally doesn't matter. There's not a use of funds that you have to provide. It's just based off the cash flow, the deposits, and it's repaid off of that. So that's an example of a niche type of financing. I don't advocate for it. It's not what we do, but I just want to use that as a reference. So now let's unplug that concept from revenue and go over to one of the other 3 C's. Because remember, we have credit, collateral, capacity, 3 C's. Traditional lenders want all 3. But let's unplug from capacity, cash flow, and then plug that model in over on collateral. Again, the collateral is what is being used for the approval. It's not the use of funds. So we don't have to worry about the use of funds, just like we don't on a merchant cash advance. All right, let's see if I missed anything else because I know I'm running long. Mika is a property manager, and so that's great. Yeah, so if you don't have to be in the real estate industry, you can be a referral partner of ours. It doesn't cost anything to be a referral partner. You can go in 509 Pacific. And with that, then you're able to help people and get paid if that's what you want to do. All right, let me see if there's any other questions here. Yeah, and Doug's bringing up a big point. The fact that we're going to cover their mortgage typically for the first 2 to 3 years is an incredibly value proposition, right? So it's going to allow people to not only be able to get approved for mortgages for real estate that they probably wouldn't have otherwise, it's also going to relieve them of some of the cash flow burdens because as we're liquidating the AR, the model is designed to bring more in than what the mortgage is each month. Now that'll tap out after a while because normally within a 2 to 3 year tail, we should be able to collect all the AR that's going to be collected, where typically the repayment on the ABL is normally a 10-year repayment. So when we say that we'll cover the mortgage, that's usually for the first 2 to 3 years. All right, well, we covered a lot. Hopefully we covered the questions you posted. Again, if you're not a referral partner, easy to become one. Go to 509pacific.org. There's a form there. If you are a current referral partner, you're ready to go, right? You're already prepared to go out and help people with shelf corps, and it starts the same. So when we're providing step 1, it doesn't matter what they're wanting money for. If it's to acquire a business, acquire real estate, start a business, it doesn't matter. Number 1 is the starting point regardless. Once we've fulfilled number 1, then we work with them to figure out what do you want to do. And if it's real estate and you agree, then we're normally going to look at ABL to fund their real estate. And then that's where we'll follow these subsequent steps. All right, great question. See you back tomorrow. No training on Monday, by the way, but we'll be back tomorrow. Thanks, everyone. See you soon.